Hi guys, it's Any, aka the Knock Trader, your friendly neighborhood swing trader, back again with another video. Now this is part 3 of our 10-part Trading 101 series. In part 1 I covered what is trading, and part 2 I covered markets to trade. You can see that in the playlist above if you haven't watched the other 2 videos. I'd suggest you watch the other 2 videos before you watch this. And in this video I'm going to be talking about market participants. When it comes to the stock markets, we have 2 types of market participants. We have facilitators who enable the exchange of securities. There are 15 centralized exchanges that facilitate buying and selling of securities, such as the London Stock Exchange and the New York Stock Exchange. You also have brokers who charge a fee to handle trades between the buyers and sellers of securities. A broker may buy securities from their customer who is selling, or sell from their own inventory to its customer. Now, some of the participants in the market are institutional investors such as big banks, hedge funds, pension funds and mutual funds. These are the big players in the market who are moving hundreds of millions, if not billions of pounds, and can really affect the market with the amount of money that they trade or invest. Then you have retail traders or investors, people like me or small trading firms who invest their own money using brokerage accounts. Then you have high frequency traders. These are algorithms created by coders to make money off the market